So, who are we going to talk about today? We're going to talk about real clients. First question, will you see the secret strategy that the Rockefellers use? Well, I can't share what they do because I don't work with them. However, we are going to talk about clients that have a net worth of 25 million, 50 million, and two that have a net worth greater than $100 million and what they're doing with life insurance. And you'll see that one of them owns a bank that's currently valued between $700 and $800 million as far as their total assets. And we'll look at what the bank is doing, which will be good insight. So we'll look at four people. These are not their real names. All confidential information has been scratched, but a lot of the policies are their actual policies along with their actual plan. So we'll cover three things for each person. Let's move on to the next two family members here, Tina and Pat. So they've got a net worth of about $40 million. They own a pharmaceutical business that generates 8 figures annually. And what I liked about them, they researched whole life insurance for about a year, really understood it, and then decided to move forward, really when they were in a position where they knew they could go all in. So their plan was and still is to fund $2 million per year into policies. We'll go through the specific details. So why do they have life insurance when they don't need it? Well, they wanted to use their policies specifically for a new home initially, and then also their business, or I should say businesses. You'll see what I mean in a little bit. To date, they've got 3 of the 4 planned policies set up, and their policies are just set up as individual policies. Remember where we said Dave's policy is owned by a family LLC? Well, theirs isn't. It's just owned under their name, and why they did that is for convenience. What does that mean, convenience? With the company that they picked, if their policies were owned by a business or a trust, they wouldn't have access to an online account, which means you can't go on your computer or mobile app and see what your values are and request loans. Not a big deal to some people because we can always facilitate that for people. For them, it was. It was a small thing that they wanted access to so they could move quickly. So they started out with the policies owned individually. Now, what's important to be aware of with this is if you transfer ownership of a life insurance policy, especially once there's more cash value than what you paid into the policy, there could be a taxable event there. So we did discuss this, and we also introduced them to Elizabeth and her team, just so everyone's aware of what could happen, and we want to make sure we prevent a taxable event from occurring in the future. So, main reason why they have policies when they don't care about the life insurance. Policy loans for the business and also the home. Why they want to use policy loans? The money keeps on compounding, and the cost to borrow, the loan rate, is fixed, so fixed forever. It doesn't renew each year at 4.76%. So when interest rates are higher than that, with what they can get through a bank, that's very attractive. If interest rates are lower than that, well, they can just take their policy to a bank and get a line of credit against the cash value. So they know how to play the game, and we'll help them with that. Let's look at the policies. So we mentioned the plan is for 4. Here's the plan. We've got Tina, Pat, 2 policies on each. You'll notice that Pat's are bigger because she got a little bit more favorable health rating, and that helped us optimize the performance. The first year, they start with a big old lump sum here, $3.4 million. This was the original illustration that they said, we like that. After the big lump sum, $2 million per year, up until about year 10. It stops when Pat is 65, but they have since we put this together, they have said, we want to keep on paying at least the minimum. So they'll keep on feeding the policy. Now that $2 million per year, do they have to pay that? No, they don't. What are you committed to? Do you remember that from Dave's policy? That minimum premium piece in red, which is about 10% of the total desired payment. The rest is going into PUAs. And on that point, PUAs, that's optional to add. You're not required to throw that money in. Remember that online account they really wanted access to? Well, they wanted access to that so they could just go online and add money at their discretion very conveniently. Adding PUAs maximizes the cash value. So first year, they've got about 92% of what they paid into cash value, which is only an 8% loss. Should I skip over that part? I don't think so, because I wouldn't like it if someone did it to me. 8% doesn't seem like a big amount, but it's a big loss to some people. And it's important just to talk about it, whatever the loss is, whether it's 1%, whatever, we want awareness. Because if you're considering a policy, make sure that you're comfortable with it. And if you're not comfortable with the loss, that's okay. Don't feel forced to do it or like you have to do it because you've invested so much time or other people are doing it. It's like, no, start when you're ready. Remember, they researched it for a year and then got their finances to a spot where they said, okay, we can hit this aggressively now. They started when they were ready to start. That's the key there. Because that 8% loss is $280,000 with that big lump sum going in this illustration. That's a lot of money to lose. Now, the next year, they get $84,000 of it back. That's the cash value growth. The following year, it grows by another $130,000. And then from that point forward, it is just compounding quickly. And in light blue, that column you see there, that's how much the insurance company is paying them total each year. It excludes their payments. They get their money back in 3 to 4 years. That's when they make up for that first year hit when we look at it. That's the drawback right there too. The upfront hit on whole life insurance. That's it, even when we minimize it. But we've got a gain by year 4 in this example. They paid in $22.5 million in this illustration. Year 20, they've got 38, almost 39 million in cash value, which is a big old gain. So what they liked about this was the fact that there's no risk, the tax benefits, and they can access the cash value like a personal line of credit instead of going to a bank. Remember the first meeting I had with them, Tina said, I'm sick of working with banks. So they just wanted to build their own with this big cash value life insurance policy. Let's hit on the generational wealth. So they don't have kids. The life insurance benefit is paid tax-free. They're very concerned about their employees though. So here is their plan structure. A lot of stuff going on. You've got Tina, Pat, and then all this stuff in the middle, which is all their different companies. So why is it so complex? Asset protection. That's often what we'll see. You'll see life insurance policies at the bottom, both for personal and business use. With these policies, the cash value is used as a tool to complement the growth of the business. Growing the business is ultimately what builds generational wealth for them and their employees. That's what's important to them. The life insurance policy is just a tool that they saw can complement their specific strategy with what they're doing. The death benefit, this can be used for key person insurance. So Tina and Pat are extremely valuable to the company. If they're gone, like who's going to operate it? The key person insurance is valuable. And remember that life insurance payout is income tax free. Do you remember the combined values of these policies? 58 million in the first year. By year 20, it's over 60 million. Now, full disclosure, they have not started all 4 policies yet. Their total life insurance to date is 30 million, which is still a pretty big amount, right? So the death benefit can be used for generational wealth, both for their business and their employees, which they're concerned about. So how can you copy and paste this strategy? A lot of information. Number 1, get a flexible policy. If you're Tina and Pat, would you want to get a bill for $2 million every year? Probably not. Most people don't like bills regardless of their net worth, at least from speaking to people. Number 2, make sure that you have the conveniences that you want. For them, it was a small thing, online account access. That's important to you. That's what we want to make sure we set up and discuss exactly how we can get that. And then number 3, don't feel like you have to have the perfect estate plan in place before you start. Remember, they just wanted to move quickly and figure things out as they go. The important thing to do there is make sure we have a discussion about that with the tax attorney. Sometimes it might make sense to get a plan in place first, but We don't always have to do that. Good information so far? I know it's a lot. I hope it's hitting on what you wanted to see today. Let's talk about Nick, which is my brother's name, but this is not that Nick. So, Nick.